Hey everybody, it's AJ with Trading Trainer, and I want to welcome you back to my office. And listen, I was really thinking this afternoon about some of the hurdles that people have been coming up against in order to be successful at investing and trading. And I've got a couple of trading rules and some errors to avoid to present with you. So let's get right to it. Some trading rules to live by. So I want you to fill in the blanks here, maybe in your mind. What positions in times of peace, not in times of war? What I want you to fill in the blank here is adjust positions in times of peace, not in times of war. You might be asking, what does he mean by times of peace or times of war? A position is going your way is when it's in a time of peace, and a position that's going against you is when it's in a time of war. And I got to tell you, there's this fear of missing out, and it can be a real SOB, but it can also, because it can get us into a lot of trouble, right? And that brings us back to the first point, right? We adjust positions in times of peace. If a position is going against us, this is not when we want to adjust it. In fact, that's probably when we want to just cash it out, get into an all-cash position. We put on our adjustments when things are going our way, and that's how we can make really successful trades. So just make sure if a position is going against you, you think twice about adjusting it. That is the fear of missing out. In fact, a lot of people think that the number one fear people have is the fear of death, or maybe even the fear of making a mistake in front of other people in the public. It turns out, this was a Harvard study, it turns out that psychologically the fear of missing out drives us to emotionally do all kinds of shenanigans. So keep that in mind. Another one that I want you to have written down is, what should we do with our trades, and then what should we do with our plans? Plan your trades, and then make sure you trade your plans. Now, I've found a lot of investors who will just show up with a pocket full of money and start investing in this and this willy-nilly without any thought to it, kind of shooting at the hip. Take time the evening before the market opens and really plan out what you're going to be doing. And then if you do such a nice plan, make sure the next day during the trading session you actually trade that plan, because that's another thing I've seen. I've seen people plan out their trades, and then the next day they throw that to the wind and do whatever they want again. So make sure we're being very methodical. Methodical investors always win out in the end. So I'm going to tell you about the second most common error that I have seen investors make. So first, we recognize patterns. You have to become amazingly good at looking at patterns in price, patterns in panic and fear versus confidence, patterns in time value, patterns in every way. In fact, I always tell my folks that work with me that they should focus first and foremost on becoming a pattern recognition specialist. I mean, I personally am just hyper observant at just things that change around me. In fact, my wife gives me a lot of trouble for this. I can't even leave the home without walking by the electrical meter on the side of our house and taking a look at how much power is going into our house at any one time. I mean, I know when the electrical water heater is going. I know when she's got her hair dryer going or the oven going. That's how hyper vigilant I am at looking for changes in patterns, and that might explain a little bit why I'm such a good market investor, is because this is first and foremost what we need to be good at, and then second, we use the tools that we have to profit from those patterns we recognize. In fact, that's called pattern utilization, and that should come second. Pattern recognition specialist first, pattern utilization expert second. A fast way to suffer trading losses is to reverse these two steps. And a common story I've always heard is, hey AJ, I've learned this strategy. Could be vertical credit spreads. It could be anything, but let's use vertical credit spreads. I learned how to trade vertical credit spreads, and every month I was making a nice, almost double-digit return. And then something happened in month 10 that erased my losses of the first 9 months. I gave all that money back plus half of my portfolio. That's a perfect example of reversing these two steps. The person learned how to use a tool, vertical credit spreads in this example, and they were applying it willy-nilly every month without paying attention to the patterns they were applying it to. Vertical credit spreads can only be used in a certain combinations of price, implied volatility, and time. And so this person or these people, if I had a nickel for every time I heard that story, I'd be a bazillionaire. They reverse these two steps, and that's just a fast way to suffer trading losses. Now that's the second most common error. You want to know what the first one is? Let's hit it. The first most common error that investors make, let's fill in the blanks. We only invest the amount specified when we take the max allowable risk to our portfolio and divide it by the maximum trade risk. Please write this mathematical formula down right now. We only invest the amount specified when we take the max allowable risk to our portfolio and divide it by the maximum trade risk. It's a mathematical formula. Coming back to that story, if somebody says, I lost everything I gained in the prior months plus half my portfolio, you know that they were not taking advantage of proper risk management. In fact, what I've got here, another fast way to suffer trading losses is to ignore proper risk management. In fact, a lot of times what people do when they learn a new strategy, a new trading strategy, is they'll say something, and you'll hear it in their words, they'll say, the first couple of months I wasn't very confident, so I only put a small portion of my portfolio. As I got more confident, I put more of my portfolio into each trade. That might explain why I lost so much when everything turned against me. Your confidence has nothing to do with how much you should put into each trade that you make out of your portfolio. It's a mathematical formula that is a function of how much are you making available for risk and how much risk does the trade have, and that will dictate your position sizing. Confidence is not a dictation of how much risk you should open yourself to, right? Use proper risk management, and that's the first most common error investors make. Now I have to tell you, these are easily correctable. And so with a little bit of awareness and understanding and then taking some action steps, you can make sure that these common errors never play through into your portfolio, and I know you're going to see some really fantastic results because of it. So I'm really thankful you spent the last couple of minutes with me. I wanted to get this off of my chest, and I did. Good luck in your trading, and till next time, best regards, AJ from Trading Trainer.